Let's dive deeper into the action with our markets reporters at the close in equities, bonds, currencies, commodities. Abigail, what are you watching?
Well, Caroline, with these very small moves for stocks recently, it makes a lot of sense to look to other clues. So one is the VIX. Investors look to that volatility index to see whether or not it's on the rise, whether these record highs can be sustained. We're looking at the VIX in yellow, and we see it's super low. But another volatility index is on the rise. That's the Skew Index in white. Some of our experts, our options experts, call it the panic index because it's far out of the money puts. You see last year, in July of last year, when the S&P 500 was carving out new all-time highs, the Skew Index was super high. This is the VIX was very suppressed. And then right going into the volatility in the fourth quarter, we see the VIX spiking higher. The Skew Index at that point, because those investors already got the call right, is starting to come down. It makes sense to keep this in mind, given the fact that we once again have this VIX in yellow, very low, and we have the Skew Index on the rise. This as the S&P 500 is at record highs, Mike.
Well, thanks, Abigail. Well, we've heard a lot about green shoots showing up in the economy, and one of the market signals that really backs that up is this re-steepening of the yield curve. The spread between 2-year yields and 10-year yields rose above 25 basis points this week for the first time since July. Actually rose as high as 27 basis points. And you can see it from the chart. It only really inverted or went negative for about a week late in August. Though the last few days, there has been a noticeable bull flattening of that curve as the long end is rallied a little bit stronger than the short end. Now, the 2-10 curve is still positive by a good 22 basis points. But if you look at the spread between 3-month bills and 5-year yields, that is telling a different story. Now, that is a curve that was inverted all the way from the middle of March through the end of October. It's since steepened. It hit as high as 19 basis points at the end of last week. But, boy, it's really flattened since then. It fell to as low as about 3 basis points today. And remember, this is the particular part of the curve that Duke professor Cam Harvey originally identified when he started looking at the curve as a recession signal in the mid-1980s. So, Damien, this thing is back in single digits, only about 3 basis points. It's clear that we may be hearing about worries about the yield curve as a recession signal again soon, Damien.
Thanks, Mike. In a world where geopolitical risk is high, multiples are full, and margins are wide, we advocate taking a relative value approach to emerging market debt. And so the chart you're going to be looking at here is the CDS cash bond basis for EM U.S. dollar sovereign debt, and you'll find that of the 16 EM-CDX constituents with available data, all have a negative basis. In other words, you can own the long bond plus the default protection at very cheap levels, meaning you can reduce your default risk, have near zero interest rate risk, and still get a positive spread above U.S. Treasuries. And this is most evident in high-yielding countries like Brazil, Mexico, Russia, Indonesia, and South Africa.